Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another Velocity Banking video. And if you're new to this channel, let me go ahead and do a little bit of flexing here. So, if you don't know who I am, I paid off my mortgage in 2 years and 9 months. And I've been saying it for like the last 1,000 videos. So, the people who are subscribed to this channel, who've watched this channel before, they're probably sick of hearing it. But the reason I talk about this is because if somebody asks me, like, hey, have you ever been to space? I'll probably say, yeah, I have been to space. Thank you. Because the equivalent of paying off a mortgage in 2 years of 9 months is probably like going to space. And, I'm so out of touch these days that, I act very casual about this. And then I just tell other people, yeah, I did pay off a mortgage in 2 years and 9 months. Oh, yeah. You've never done that? And I stole that from The Simpsons. So if you ever watch The Simpsons, basically there's a scene in The Simpsons where Homer's talking to his coworker, and then he's like, "Oh, yeah, like I met the president, I met the Smashing Pumpkins, which was like a huge 90s band, and then I went to space." You never went to space? And I'll play it all for you. So let's go ahead and play it.
And this is when I was on tour with the Smashing Pumpkins. Oh, and here's a picture of me in outer space.
You went into outer space. You.
Sure. You've never been?
I have been to outer space because the equivalent of going to outer space is paying off a mortgage in 2 years and 9 months. And so that's what's going to happen with me. I'll just be like, yeah, I paid it off under 3 years. Oh, you didn't do that, right? Just casual, just flexing, just bragging a little bit. Okay. All right. So let's go ahead and get started with another velocity banking review. So what is velocity banking? Well, it's just a debt payoff strategy where you throw all of your money to debt using something called a line of credit. So if you don't know what a line of credit is, it's basically a financial tool where you could borrow money, pay back, and then use it over and over again, right? So I don't know if you ever heard of something called a home equity line of credit. Basically, what this means is that you could go to the bank's website, click a button, and then they'll dump up to whatever the credit limit is. So in this case, it'll be $373,500, right? They literally click a button, bam, $373,500, and they'll charge you an interest rate, maybe 7 to 10, usually 7 to 10%. And then, so I have tons of lines of credit, right? So this includes credit cards because credit cards are a form of line of credit. You swipe, pay it back, and then use it over and over again. And if you count up all the lines of credit that I have over $739,000 in lines of credit, which makes me the top 0.01% according to ChatGPT, right? So that's another kind of I went to space moment. Didn't you? Okay. Is people like to be act like, oh, they're all like the foremost experts in credit. You need to check your credit score. Mine is over 700. And it's nice to check your credit score, but you know what's really more important? The amount of money you can borrow. That's what credit is really about. So if I just, casually get into conversations like, "Oh, cool, you're into credit. Yeah, I have $739,000 in limits. How much do you have?" It's probably somewhere around there, right? Probably in the top 0.01% like me. Oh, you've been to space? I've been to space too. Thank you. Okay. So, yes, that is where I'm at today, which is why I'm totally out of touch and with the average American. And for the most part, I kind of don't care. Actually, someone just texted me. Let me see what that text is about. All right, I'm back, folks. All right. Hey, so what was I talking about? Yeah, I went to space. That's what I was talking about. Okay, so here's the secret: getting all these lines of credit, which will you hear me say in many, many videos, is that banks don't lend money to people who need it. You know how I got these lines of credit? I just went to a bank when I didn't need money. And that's literally what I did. Got rejected here and there, but I never went to a bank when I needed money. Because when you go to a bank when you need money, it's like pretty much 100% denial, right? They see a person who is unlikely to pay you back. That's why they don't lend money to people who need it. Okay. So people are like, well, how do you do this when you're low income? What are you talking about? You're not going to have that much debt when you're low income unless you lie to the bank about how much income you make, right? Because the bank wants a low risk borrower. Remember that one time when one of your friends asked you for money and then didn't pay you back because what was the key word that they said when they asked for money, which is, "Can you lend me some money? I really need it." And the bank as an institution knows that those type of people will not pay you back. So there's two types of people that the bank doesn't like, is that people who pay you back too early and people who never pay you back. But at least with people who pay you back too early, you recover, um, your funds, right? Whereas people who never pay you back, that's very, very bad, right? That's why your credit score drops to like 500 or 400 when you borrow money and then you never pay it back. Whereas when you pay back money early, maybe it might ding your credit score a few points, but it's still going to be pretty good. Okay, so that's really what how credit works. Now, when we do velocity banking, we actually assume we have a free and clear line of credit. So let me just kind of go over this. So the first step to doing velocity banking is creating a budget. So you have your income, expenses, leftover savings, and then when you do your expense breakdown, you have to list every single debt that you have, right? All the black font is in debt, and then the red font is the non-debt expenses, food, gas, insurance. We just clump them all together because we're concerned about paying off the debt, right? Now, this may or may not be an accurate number, but we're just kind of giving a ballpark to see how this works. And then what we're going to do here is in the income and expenses part of velocity banking, we're actually just going to copy it, right? We're going to copy the debts, but what's important is that we have to create a mindset shift of saving money, right? So saving money is not the way when it comes to velocity banking. So you see this big fat zero here when it comes to savings. So if you ask the average person, hey friend, what's better, saving 500 or saving zero? They'll say, oh, definitely 500, because what if you need your money in case of emergencies, right? And that's what really our lines of credit are for, right? It's that easily accessible cash as we pay off debt. Okay. So if you take a look here, this is just what I do. Money comes in, I don't save it. I treat the money like a hot potato. So when you're doing velocity banking and you have debt, you're treating the money like a hot potato. So as soon as money comes in, you want to pull it out or move it into the line of credit, right? And so for this example, we're going to assume we have a $70,000 free and clear line of credit. And what we're going to do is, with the help of this line of credit, increase our cash flow, right? So what we're going to do is put our entire paycheck into the line, take our expenses out, and rinse and repeat over and over again. Now, the savings and the cash flow amount is the same for now. But if we move some of our debt, we're going to help increase our cash flow. And we use something called the cash flow index. So I didn't start using this cash flow index formula until someone sent me a real life case study through email. It was actually their numbers, right? Of 22 debts. Okay. And I was so like confused, like, how do I tackle this? 22 debts and $4 left over. And we actually did a live stream on it, right? Live stream. I would call this the PhD Velocity Banking course. If you want access to that live stream, go ahead and join the 99-cent YouTube channel membership. But basically, I was like confused how to know which debts to pay off, and then I was like, oh, cash flow index, right? 22 debts, you have a ranking order, and then you know which ones to move into the line of credit. Relatively easy. So you can see here the formula is the balance of the debt divided by the payment, and then it gives you a ranking system. Okay, so the lower the number, the more bang you get for your buck. So for example, if I pay this $30,000 off, I get 1050, $1,050 back in my cash flow, right? You see how that works? But if I pay off the mortgage, look at this high number here. If I paid $200,000, I'm only going to get $843 of cash flow back in my life, right? So you can see that this number, this big number, essentially means, hey, pay it off last because you get such little cash flow, right? So that's essentially what that means. So what we're going to do is take these low ranking numbers and then move them into a line of credit. Okay, so this is going to be 5, 8, 15, 30. And then what we're going to do is take the sum of that, so there's 58,000, and then move them into the line. Now, will the bank give you a free and clear line of credit when you have all these debts and you only have $500 left over? The answer is probably not, because the bank thinks you're a bad person if you need money, and you probably need money here, right? So why do we teach this about having a free and clear line of credit when you clearly need money? Well, it's because it's kind of one of those things where it's like, if you learn to do it right from the beginning before you tackle on debt, you would never be here, right? I learned like velocity banking before I had the ability to tackle on debt. I used to make like 20,000 a year. I was like, why am I learning this? And then years later, oh, paid off a mortgage in 2 years and 9 months, and then $739,000 in lines of credit. So there's a reason why I kind of keep emphasizing do it right, but a lot of people, they don't follow the order of operations. And what they want to do is they want to crash their car metaphorically, right? With their finances and then figure out how to do things right. I don't know why people do that in this country and probably the rest of the world too. But if you crash your car, you know, and then you want to learn how to drive, that's kind of weird, but that's what we do with their finances. Okay. But we're just going to assume we have a free and clear line of credit. And if we take a look here, it's 58,000, right? 58,000 in the line of credit. And then so what we're going to do is do this. And then once we move that 58,000 into the line of credit, oh my goodness, take a look at this, right? This is the most clickbaitiest moment of your life. These payments, these 4 credit cards go to 0, right? So we literally took this $537 and 5x'd it. Not 10x'd it like Grant Cardone would like, but we 5x'd that number to 2,500 without making more money. See how the income is the same? The expenses have been shifted over, right? But somehow this number gets multiplied by 5. Okay. Now, one of the reasons why it does is because this interest rate's much lower than the credit card, right? So if you know how credit cards work, well, basically, or just debt works, is if you have a secured asset, they give you better terms, right? So if your line of credit is backed by your home equity, they'll give you a lower interest rate. So the final thing is that your paycheck goes into the line, you take your expenses out. So the 6,500 that you get into your checking account, you treat it like a hot potato, and then you make it as an overpayment to your line. So what happens is that kind of like when you overpay a credit card, you satisfy a minimum monthly payment, and then you're lowering the interest because it lowers the average daily balance, right? So that's what we're going to do. So I'm going to do this right here. What we're going to do is take the previous month's balance plus the previous month's interest minus the cash flow, which is 2510.42, right? So that's what we're do. And this after every single month, the balance will go down about $2,500. And if we want to calculate the interest, multiply by the interest rate, and then you divide by 12. All right. So I'm going to copy and paste, and then copy and paste. And then we see that in 25 months that it's over. The credit card debt is gone. Oh my goodness. All right. So 25K, 25 months, and then 58K, it's all gone. See how easy it is? Yes, I did go to space. Thank you. All right. So let's go here. And then now we have 3 more loans, which is auto, student, and mortgage. And let's go ahead and get rid of those. So that's going to be, we're in month 25. So we just put 25, 25, 25. And then same thing, use the cash flow index, use the lowest ranking debt. So I'm going to move this 13 grand auto loan into the line. So let's go ahead and do that right here. And then plus 13902.43. And then this is 0. And then this is going to be $3,000 of cash flow. And then this is going to be right here. And then this is going to be minus 2928.83. All right. So now what we're going to do here is in 30 months, this is all paid off, right? So in 30 months, this is all paid off. And then 58 plus 23. And then this is going to be 81K. And then now in 30 months, it's all paid off. So I'm just do this right here. So 30, 30. Now we have a student loan here. Now let's go ahead and pay off the student loan, 49 grand into the student loan, or I'm sorry, into the line of credit. That's the amount remaining in the student loan. And then I'm just going to do this. Oh, wait, actually, that's the wrong one. My bad. It's going to be here. And then this is going to be plus 49148. And then what's our new cash flow? It's $727. This is now 0. Bam. And then $3,656.57. So let's go ahead and pay it off. And then this is going to be minus 3656.79. And then copy and paste this, and then blam, and then in 44 months, it's all paid off, alakazam, and then I'm good. All right, so 44 months, and then it's gonna be 81 plus 60, so it's 141K. And then where's our mortgage now? So in 44 months, it's all gone. And so now $200,000 balance, $184,000 current balance. And so now we have two ways to pay this off. We could just directly put this cash into the loan, or as an extra payment, or you could use our line of credit, right? So what I just want to show here is that even if you use like a higher interest rate line of credit, it should be fine, right? But a lot of people are afraid because it's like, oh, the interest rate difference. And it's like, yeah, it kind of matters, but not really if you do it right, right? So 6,500, and then let me just see if I have this right. I think the balance might be off. 184,058.01. 184,058.01. And then let me just see right here. So interest rate is actually 7.5. But you see how we changed it from 9 to 7.5 and only made like a $200 difference or $300? And then if we use a 30% credit card, right? Like 15 grand versus 7.5, which is 11 grand. Now, I know what some of you are thinking. Why in the world would you use a 30% credit card to pay off your mortgage, right? The answer is if you're looking for more credit. So we have to understand that sometimes the best credit decision is not the best financial decision. We might have to give a couple more bucks to get more credit. And so what I mean by that is that, I have this business credit card here, right here, that it magically went up to 17,500, even though it used to be 10,000. Why is that? Because I kept using it, paid a little bit of interest, and then, just they just magically gave me more credit. So again, I'm not trying to save money at every single turn, but I want to strategically pay money so that I can get access to more money, right? So that might be a reason why I might use a 30% credit card. Or if you want, just dump the cash directly into the loan, right? You pay it off quickly and it's 0% money. So you don't have to use a 7.5% line of credit. That would be ridiculous. But if you want to, sure, why not? Okay, so now that's going to be 3.7 years. So let's go ahead and do that, and then this is going to be 0, and then this is going to be 44 divided by 12 plus 3.7, and then 7.37 years, and then we are debt free. All right, so yes. Okay, 7.37 years, and then we're debt free, and that's pretty much it. All right, well, that's it for today, folks. Yes, I have been to space. Thank you very much, and I'll see you on the next video. It's Korean Lantern Mentorship.